The economy does not move in a straight line. It moves in cycles. And no matter whether we are talking about the United States, Europe, or any major economy in the world, those cycles always pass through the same familiar stages: recovery, expansion, overheating, and crisis. You can call them spring, summer, autumn, and winter, just like in nature. But simply knowing the names of the seasons is not enough. That knowledge alone does not protect your capital. What actually determines whether you lose money, preserve it, or even multiply it comes down to a much simpler question. In each phase of the economic cycle, where is your money? And are you acting like someone who understands the season, or like someone who is simply reacting to headlines and emotions? Today, I don't want to talk about theories, forecasts, or predictions. I want to talk about action. Specifically, what should matter to you in each phase of the cycle, when you should wait, when you should begin deploying capital, and when the very tools that once helped you move faster quietly turn into the things that pull you under. When the economy enters the late stage of expansion, the overheating phase, what we might call autumn, everything on the surface still looks fine. Employment is strong, consumption is healthy, companies are still reporting profits. But beneath the surface, inflation is elevated, interest rates have already risen significantly, and debt across the system is stretched tight. This is also the stage where the system quietly prepares to move into crisis, the winter of the cycle. And this is where one asset becomes more important than almost anything else: cash. At this stage, cash stops being unproductive money. It becomes optionality. It becomes time. It becomes choice. History is very clear on this point. During the 2008 financial crisis, many banks and investment funds collapsed not because their assets were worthless, but because they did not have enough liquidity to survive short-term shocks. Lehman Brothers did not fail because it chose the wrong assets. It failed because it could not withstand funding pressure. By contrast, Warren Buffett entered 2008 holding more than $40 billion in cash. That single fact allowed him to invest in Goldman Sachs and General Electric on terms that had never existed before in modern financial history. In a crisis, cash is not defensive. It is offensive power, delayed in time. Now, when the crisis fully arrives, the deleveraging phase or winter, markets usually fall violently. Headlines become relentless. Fear spreads rapidly. This is when many people start believing that prices are finally cheap enough. But this is where most people get it wrong. During winter, corporate earnings are still deteriorating. Bankruptcies are still rising. Monetary policy is still operating in emergency mode. The investors who survive long-term do not rush in aggressively at this stage. They preserve liquidity, they observe carefully, and they wait for the next phase to begin forming. That next phase is recovery, the spring of the economic cycle. Interest rates are already very low. Emergency support has been deployed, and while the news is still bad, it is no longer getting worse. This is when equity markets typically begin to price the future, even as people remain psychologically trapped in the pain of the past. In the 2008 to 2009 cycle, the S&P 500 bottomed in March 2009, precisely when U.S. unemployment was still rising and public sentiment was deeply negative. Those who waited for the economy to clearly improve missed the most powerful part of the rally. Stocks do not wait for the economy to heal. They move first because they reflect expectations, not the present. As the economy transitions into stable growth, the summer phase, assets begin to compound naturally. Employment improves, incomes rise, confidence returns. This is the phase where most wealth is created, but this is also the phase that quietly sets the trap. People begin to believe that good conditions are permanent. Debt grows faster than income. Leverage starts to feel safe, even intelligent. And this is exactly where many investors make mistakes that only become visible much later. Let me pause here and make something very clear, because this is the part almost nobody talks about. Most people don't lose money because they chose the wrong asset. They lose money because they acted at the wrong time. The same asset can be brilliant in one phase of the cycle and devastating in another. The difference is not intelligence, it is timing. Holding cash during recovery feels foolish. Buying defensive assets during expansion feels boring. Reducing leverage when everything is going well feels unnecessary. And yet, These are exactly the actions that separate those who survive from those who don't. The paradox is that doing the right thing often feels wrong in the moment. Buying when fear is still high feels uncomfortable. Waiting when everyone else is making money feels painful. Reducing risk when confidence is widespread feels lonely. That psychological pressure is not a coincidence. It is the mechanism through which cycles transfer wealth. Markets do not reward bravery, they reward alignment. If you act like it is still winter when the cycle has already entered spring, you will miss opportunity. If you act like it is still summer when the cycle has moved into autumn, you will invite disaster. Understanding this rhythm is far more important than being right about any single forecast. Now, while stocks reflect expectations, real estate reflects current cash flows and interest rates. That is why real estate typically lags the cycle. After the 2008 crisis, U.S. home prices did not bottom alongside equities in 2009. They continued falling until 2011 to 2012, after interest rates had remained low long enough and forced selling had reached exhaustion. The best real estate opportunities tend to appear when liquidity is scarce and sellers need cash more than they need high prices. Gold plays a very different role. It is not a growth asset. It is a trust preservation asset. Gold tends to perform best when the cycle enters its most fragile stages, when inflation is elevated and central banks are trapped between controlling prices and avoiding recession. Before the 2008 crisis, gold rose sharply from around $560 to over $1,000 as confidence in the monetary system began to crack. One of the most consistently destructive mistakes in financial history is the misuse of leverage. Leverage can only play a constructive role early in the recovery phase, late spring into early summer. When rates are low, valuations are depressed, and systemic risk is falling. Once the cycle enters its late stage, leverage stops being a tool and becomes an explosive. Most financial disasters do not come from choosing the wrong assets, but from using leverage at the wrong time. The paradox is that many people understand the cycle and still lose money, not because they lack knowledge, but because they act out of sequence. Some hold cash for too long, entering recovery while still thinking like it is a crisis. Some buy defensive assets too early, lose patience during expansion, and sell right before risk truly materializes. Others use just a little leverage late in the cycle, convinced they will exit in time. The mistake is not the asset. The mistake is the order of action within the cycle. If you imagine an investor moving through a full economic cycle, the difference becomes obvious. After a crisis, during a recovery, capital is deployed gradually, without urgency, and without leverage. During expansion, assets are allowed to work, while risk is quietly reduced and buffers are built. As the cycle tightens, preservation becomes more important than maximizing returns. And when the crisis finally arrives, there is no forced selling, only liquidity and choice. Most investors do not lose money because they are unintelligent. They lose because they react to the present while markets move toward the future. The media talks about what just happened. The economic cycle reflects what is about to happen. Retail investors ask what to buy right now. Those who last ask which phase of the cycle we are in and which actions fit that phase. The difference is not knowledge. It is rhythm. You do not need to predict exactly when the next crisis will occur. You only need to avoid acting as if summer will last forever when the cycle is already shifting. And that is why, in the next video, I will address the most important question right now: where we actually are in the current economic cycle and which signals truly matter when reading the season, without being distorted by headlines or crowd emotion. If you've stayed with me until this point, you are already far ahead of most market participants. And if you want to continue building an investment mindset based on cycles, systems, and calm decision-making, follow Ascend Your Mind. Because in investing, it is not the most active people who win, but those who move in sync with the cycle and survive long enough to take advantage of it.